Hello and welcome to the Trends and Futures live training webinar with DeCarly Trading. My name is Gary Kamen, trader and chief market strategist at Trends and Futures. For this two-part webinar, joining me today is Carly Garner, presenting day trading tips and tricks. Carly is an experienced futures and options broker with DeCarly Trading, a division of Zaner in Las Vegas, Nevada. She has also authored 3 books, A Trader's First Book on Commodities, Currency Trading in the Forex and Futures Markets, and Commodity Options, all published by FT Press, a division of Prentice Hall. And in my presentation, I'll show you what truly lies beneath all trends. You'll get a clear view into the mind of the markets, all the markets. So before we begin, a quick comment on questions. There's a question box at the right-hand side of your screen. Please hold off on any questions until the end of the webinar. We will provide enough time for your questions. So without further ado, here's Carly Garner. Take it away, Carly.
All right, I appreciate the introduction, and I'm grateful to be here. Excited to spend the afternoon with everybody. I hope that you walk away with a little better idea of what it's like, or maybe some of the do's and don'ts of trading futures, particularly day trading futures. Okay, let's just jump right in. We're going to talk about day trading tips and tricks. And you're going to notice a lot of the slides that we use will have pictures of charting application. We use the Barchart Trader. And this has actually been a good experience for me as well to get familiar with Barchart Trader. It's a fabulous platform, and it's really broker agnostic. It can be used with almost any FCM. So keep that in mind as we move along. Before we start, I just want to make sure everyone understands that trading futures and options is risky business. There's substantial risk of loss. I should clarify that. There's substantial risk of financial loss in trading futures and options. Doing so may not be suitable for everybody. It's not for the faint of heart. This is me. My name is Carly Garner. If you have any questions or comments regarding today's presentation, feel free to contact me. If you're on social networks, Facebook and Twitter, look us up. The Twitter handle is @CarlyGarner, and on Facebook we're under DeCarly Trading Commodity Broker. But if you just type in DeCarly Trading or Carly Garner, they'll come up. You may have run across my name in Stocks and Commodities magazine. I write a monthly column called Futures for You. And if you haven't seen it, pick up a copy. It's actually a pretty fabulous magazine, and I'm a little biased to my column, but we try to basically answer questions that I get from clients and followers, and do it in the column format. So hopefully readers benefit from it. I also write 2 newsletters for our brokerage clients. Again, we're DeCarly Trading. We're a Las Vegas-based commodity brokerage service. And we write the DeCarly Perspective in the Financial Futures Report to give our clients insight on what's going on in the markets, where we think they may or may not go, some trading ideas and specific trading recommendations. Of course, we're not always right, but we've been doing this for a long time, so hopefully we can keep you out of trouble at minimum. If you want to sign up for a free trial, you can do so at our website, decarlytrading.com. Okay, let's jump right in. The biggest question that maybe on everybody's mind is why day trade? Well, day trading is exciting. Let's face it, it speeds up the profits and losses. Basically, traders that are day trading are using the same technical indicators that they would use on a daily chart or a monthly chart, but instead they're using it on an intraday chart. It might be a 10-minute chart, it may be 30 minutes, whatever the case is, they're speeding up the profits and losses. And that can be a good thing or a bad thing. Another benefit of day trading is there's no overnight risk, and there's low barrier to entry. And what I mean by that is there's low margin. I mean, in theory, you could open up a day trading account with $1,000 or $2,000 and go to town. I'm not saying you should do that. In fact, your odds of making money on something like that probably are pretty low, but it is possible, and that's why a lot of traders are attracted to day trading. And this is a good example. This actually just occurred a couple of weeks ago. On January 16th of this year, 2015, the E-mini S&P fell 30 handles in 3 hours. To put that into money terms, that's the equivalent of $1,500 profit or loss to a day trader. And somebody may or may not have lost that with a very small margin requirement. Now, we're going to discuss this in more detail, but keep in mind, just because, well, let me put it this way, a lot of day trading firms advertise very low margin rates, $300, $500 to buy or sell an E-mini. But keep in mind, if you're trading on that much leverage, the odds of you catching a move like this are slim to none. You'd have to sell the exact high and buy the exact low. Otherwise, you're going to just get knocked out in the ebb and flow. So as we'll talk about later, you want to make sure you're well capitalized. If you're undercapitalized, the odds of success diminish greatly. The downfall of day trading is the flashing lights and the quick fills, the adrenaline. It often gets the best of traders. We're human. We have human emotions. And when things are moving and things are exciting, we get excited. Unfortunately, day trading magnifies exposure to destructive temptations and obstacles. A lot of day traders are lured into overtrading, over-leveraging. They make emotional decisions, and a lot of times they'll unfortunately get caught up in economic announcement volatility. One thing I've learned over the years is you're far better off staying out of the markets during big announcements like the non-farm payrolls or GDP, things like that that really have the ability to move the markets. You really, unless you somehow have been leaked information from the government report, which that would be illegal and you'd have other problems. But other than that, there's really no way to predict what the report's going to reveal. And even if you do know what the report's going to reveal, you don't know how the market's going to react. So you're better off typically just staying away from economic reports as a day trader. And I know that we've all heard of this, trading is mental. Well, it really, really is. My favorite quote in regards to trader psychology is this: nothing gives one person so much advantage over another as to remain always cool and unruffled under all circumstances. Obviously, this is easier said than done. But the gist is, whether you're making money or you're losing money, don't take the emotion that you feel from those trades into the next trade. Don't trade with revenge. And again, these are things that are easier said than done. But I've learned if you do find yourself in that emotional stage, just walk away from the computer, maybe for a day, maybe for a week, maybe even for a few months. But get away, because nothing good will come of forcing trades while you're not thinking clearly. The biggest emotion that traders deal with is fear, and this isn't something you've never heard before. This isn't new. But we're just using this to emphasize and remind people. The fear of loss or being wrong is natural, but it's necessary in small doses. If you're completely fearless, you're probably just being foolish. And eventually you're going to blow out your account. Too much risk and swinging for the fence. It might pay off in the short run, but in the long run, you're not going to do very well. However, if you're on the other side of the coin, if you're too fearful, if you're too scared of actually pulling the trigger, you're going to end up being late to enter or early to exit, and you're not going to do very well with that either. The market's bigger than we are. Be well researched and educated, but understand what we're facing here. We're trying to beat the market, and so is everybody else. So the odds of us being successful at beating the market aren't necessarily stacked in our favor. And once again, undercapitalization breeds fear. So if you're trading either too many contracts at a time or you just have too little money in your account, you're going to be scared. You're going to be more scared than somebody that's trading with a reasonable amount of money or a reasonable number of contracts. So you're already putting yourself at odds with the market. The other emotion we deal with as day traders or any type of trader is greed. Greed is good, according to Gordon Gekko. And it is. He's right in some aspects. Greed brought you to trading, and it creates opportunity, but it also creates misery. Greed represents the need to profit and the need to be right. It often prevents traders from taking profits or losses. I'm sorry, from taking profits or taking losses before they get out of hand. One thing that I've noted a lot of day traders throughout the years, they tend to have limit orders that are placed for their profit, to take profits. For example, if they're long a market, let's say they're long the E-mini S&P, and they think it's going up to 2030, they might put their limit order at 2030. A lot of times, if the market gets up to 2029, 2029.5, they wait for that limit order to get filled. And I can't blame them. The odds are, if it's gotten that far, it probably will get to their price. But I can't tell you how many times I've seen traders haggling over that last $1 or $2 in the market turn a winner into a loser. Because once it starts turning around and going the other way, then it's hard to pull the trigger. You know, on a trade you were making X number of dollars, but you were at one point making twice as much. So it becomes an emotional game. If the market gets anywhere near your limit price, just take the profit, move to the sidelines, and wait for the next trade. A bird in the hand is worth two in the bush. And this is my personal opinion, of course. Other people might tell you something completely opposite, but the idea is there's no right or wrong way to trade as long as it's working for you. And everybody's personality is different, so you just have to find what you're more comfortable with. But in my opinion, short-term traders are better off setting targets at support and resistance and locking in profits, or at least peeling profits off. You may leave a contract or two on as a flyer, just in case the market breaks through support and keeps going, or breaks through resistance and keeps going. But typically, if you're taking profits near support and resistance, you're usually going to be better off than trailing a stop. Because by definition, stop orders are only triggered if the market moves against you. So you're leaving some money on the table. Every time you get stopped out, by definition, you're leaving money on the table. The third emotion is frustration. And basically, the idea is baggage from previous trades often dictate future trades, but it shouldn't be that way. Whether it's the pain of taking a loss or the angst of taking profits early and you feel like you left a lot of money on the table, don't allow that to dictate what you're going to do next. Revengeful trading is unproductive. A lot of traders, if they feel like they left money on the table or they feel like they took a loss unnecessarily, maybe they were stopped out of a trade before it went their way, they get revengeful and they begin adding position size, they force trades, etc. But the only thing to do when you're feeling these types of emotions is to walk away. Okay, let's talk a little bit about day trading margin. And a lot of people don't necessarily understand, but intraday margins are set at the brokerage level, not the exchange level. Now, with that said, you have to keep in mind, brokerage firms make a living on commission, and they often entice traders with low rates. Now, take it from me, because we are brokers. We run a brokerage service, so I can see from both sides how these types of things work. A lot of brokerage firms out there will advertise that they'll give you $300 E-mini margins or $500 E-mini margins, whatever the case is. But what they don't tell you is if you put an E-mini trade on with a $300 margin, and next thing you know, you're down a full handle on the S&P, which isn't much. It's normal ebb and flow in the market. They'll go in and force liquidate you if they think that you're a little over leveraged. And trust me, if you are using the $300 to $500 margin to the max, you are over leveraged, and they won't hesitate to. We believe that low margins and over leverage burden traders with dismal odds of success. You know, it's great if you buy an E-mini S&P. Let's say, for example, let me give you an idea of what I'm talking about with a $500 margin. Let's say you have a $2,000 account, and we're just going to simplify everything. In theory, if your broker is offering you a $500 E-mini margin, you can buy 4 contracts in a $2,000 account. I would never recommend that you do this, but I'm just explaining to you what would be possible. However, if you buy 4 contracts, the market dips $1 against you, which really, again, is not very much at all. We see that in the blink of an eye. Your account's going to be force liquidated because, well, basically because you went under the margin requirement. The margin requirement is $500 per contract, and you maxed out your account. So if the market goes against you a point or two, your brokerage firm's just going to blow you out. And they do this because they don't want to take the risk of you losing more than you have on deposit. I don't necessarily blame them for doing that. It's, you know, as a trader, it's our decision whether or not we want to use the leverage that's being given to us or not. So leverage doesn't hurt people. People hurt themselves by using the leverage that they're given. I believe that a brokerage firm that's encouraging you to trade on a $300 to $500 margin in the E-mini S&P really isn't doing you any favors. Please don't choose a brokerage firm simply because they have the lowest margin rates. It reminds me of, remember that commercial they used to play with in regards to smoking? It was an anti-smoking commercial, but the Shards of Glass company, they would sell, you know, basically the idea was cigarettes and were similar to selling people glass. eventually will slowly kill them as they consume it, but that their goal was to make money. So it's not unlike brokerage firms and leverage. So just be careful and know what you're shopping around for. With intraday margin, as a day trader, you're given a lower margin than the exchange actually charges to hold positions overnight. So this means you have to be out by the close. And it is your responsibility to know the closing times of the products you're trading. Not all products close at the same time. The E-mini S&P closes a little later than the grains. The meats close a little later than the grains. I mean, it's pretty confusing. But you, as a day trader, you have to know. And it's really, it's not acceptable to hold positions overnight if you do not have the margin to do it. Your brokerage firm will probably let you do this every once in a while as a courtesy, but trust me, it's not in your best interest. It puts you on the margin department's radar, also known as the bad side, and it's just not somewhere you want to be. If you're going to day trade, follow the rules. The rules are there for a reason. They're there to protect you as well as the brokerage firm. In my opinion, if you are going to day trade, I believe that you should keep your account well funded. And by well funded, I mean you should have enough money to hold the positions beyond the close if you need to. And this is ideal because, trust me, the markets don't cater to you. You need to cater to the market. Your strategy and market fluctuations aren't going to necessarily comply with the closing times. So a lot of times it's, for example, if you're a counter trend day trader, a lot of times the market will sell off and it'll close near the lows, but it'll turn around and rally into the next day. And it makes a lot of that move after the close of today's session, and it'll do it on the open of the next session and the overnight session. So if you're strictly a day trader, if you absolutely have to be out by the close because you don't have enough money in your account to hold your positions beyond the close, you're really doing yourself a disservice. And be aware of the purpose of margin and even day trading margin. Overnight margin is more expensive for a reason. It's set by the exchange, and the exchange believes that an account should have enough in their account, or I should say a trader should have enough in their account to cover what they believe could be a potential daily price fluctuation. So an E-mini S&P margin fluctuates between 4,000 to 6,000, and the 30-year bond, which is the ZB, it's anywhere from 2,000 to 3,000. These are not just random numbers. These are numbers that have been mathematically calculated based on what the exchange believes the risk is in a 24-hour period. So just because your brokerage firm is offering you less risk, less margin or lower margin, it doesn't mean there's less risk. The day trading margin was simply created by brokerage firms to encourage higher volume, not necessarily to, as a nice gesture to be nice to the clients. It's in the business of creating round turn fees. And that's one way that they've found to do it. Okay, beware of market volatility and understand the consequences. Volatility is dynamic. It's always changing. As a day trader, you need to be aware of what's going on in the markets, even if it's on a different time scale. For example, if you're trading the E-mini S&P, you want to pay attention to the VIX. VIX is obviously a volatility measure on the S&P. When the VIX is really high, you want to understand that your day trading method should be maybe tweaked a little bit. You don't want to take buys and sells at the first support and resistance levels. You want to make sure you're giving the market room to breathe, because trust me, it will breathe. When the VIX spikes up, sometimes you'll see the S&P move 50, 60, I've seen 70 to 100 handles in a single trading day. So you want to account for these types of things and just pay attention. And a lot of traders are kind of suckered in by low volatility markets because they think that, what could go wrong? The market's trading sideways, it's not going anywhere, things are quiet. But trust me, it's inevitable. Low volatility is often followed by high volatility, and that during those low volatility times, there's absolutely no room for lazy risk management, because that's exactly when things can explode for apparently no reason or for no foreseen reason. And if you're using the Barchart trader, you can easily track the VIX. This is a daily chart of the VIX, and obviously as a day trader, this may not help you so much intraday, but at the end of every day, you should know where the VIX is, know what kind of market conditions we're dealing with, so you can understand how much leeway and how much room you should be giving the market when you're deciding to place your stops, if you use them, or your entries and exits and things like that. Another thing to be aware of as a day trader is windows of low volatility, whether you're looking at intraday or daily. In this particular case, we're looking at intraday charts. You notice kind of in some of these little consolidation areas, volatility is real low, and then it's followed by a big spike in volatility, where the key is, as a day trader, at least in my opinion, again, everybody has their different ideas and they've found different ways to do things, but in my opinion, when the market's in a low volatility window, you want to basically stay away because there's not a lot of opportunities there, and if you happen to be caught on the wrong side, you could get yourself into trouble. In my opinion, I think you're better off waiting for spikes in volatility. It may be a big sell-off or it may be a big rally, and then try to look for support and resistance at that point and maybe take a position there. If you'll notice, this quiet time was followed by a big spike down, right down to support on the trend line. That might have been a good opportunity for the bulls. Again, this is my opinion, but ideally I believe traders want to be flat during periods of low intraday volatility, sideways trade, because these are the times where there's risk of unexpected or unexplained moves. Just when you think nothing's going to happen is exactly when something does happen. And if you just happen to be in the wrong place at the wrong time, you're going to be in trouble. Just ask anyone that was trading the Swiss franc last week. You know, you just never know when things are going to go from quiet to not so quiet. Being flat gives traders the opportunity to take advantage of extreme price moves once they occur. So a large sudden sell-off on stop running is often a good buying opportunity, or a short squeeze can often be a good selling opportunity, but you want to be patient. The more volatile the market is, the higher the VIX is, the more you want to be patient as far as waiting for extreme levels. And I don't believe it's typically a good idea to trade a quiet market. Don't be eager to enter at soft support and resistance levels. For example, a lot of day traders use pivots, and pivots or any type of support resistance type of day trading method. They'll typically give you 3 to 5 areas of support and resistance. In a volatile market, you really want to kind of just ignore the first couple levels because the market's probably going to break through them and go to the next level. If you're looking for extreme prices, make sure they really are extreme. Okay, let's just take a look at a few indicators possibly that day traders may use. Here's my general opinion on indicators. Trading is basically competing with all of the market participants. Everybody has access to the same indicators, the same news, and the same price data, generally. So I believe that all oscillators, and I'm talking about stochastics, RSI, all of those types of things, they're probably in the long run going to yield the same results. Some of them are quicker to trigger, some of them are slower to trigger, but in the long run they probably are going to do about the same because they're all telling us the same thing. They're all telling us what the market has already done. Therefore, it's how you use them that matters. A lot of day traders try to trade on a short-term bar. They might be looking at a 1-minute chart, they might be looking at a 5-minute chart, but I believe that this creates a lot of unnecessary noise that's going to impact their technical signals. And on top of that, when people are trading the lower time frames, the 5-minute bars, the 2-minute bars, whatever it is they're looking at, they tend to trade higher quantities. I believe that they're probably better off from a probability standpoint trading smaller quantities in longer time frames. So in other words, instead of trading 10 lots at a time using 1-minute bars, just trying to catch a point or two here and there, why don't you try trading a 1 lot with 30-minute bars or maybe even 60-minute bars and see how it goes? I think most people will find that it takes a lot of the unnecessary noise out of the chart. It reduces some of the false signals. Smaller time frames are going to produce a lot of false signals, and if you're trading in big size, like for example, we'll use the previous example. If you're trading 10 contracts at a time using a 1-minute bar and you're looking to catch 1 or 2 handles in the S&P, the odds are you're probably not going to lose a lot because you're probably placing tight stops and that sort of thing. But trust me, the chopping in and chopping out can do just as much damage as being dead wrong on a 1 lot. And on top of that, if you're trading 10 contracts at a time looking for a small move, you're paying a lot of money to your broker. Most people here are conscious of the commission that they spend, but they try to, they look at commission as a round turn rate, but what they should be looking at is how much they're spending based on the quantities they're trading. The easiest way to cut commission is to trade lower quantities. Okay, counter trend or trend follow? This is a big question, and this isn't a question I can answer for you. Everybody's wired differently. Everybody has to determine what's best for their personality, but here's the overall idea. Whether you're day trading or position trading or whatever the case is, this is really the essence of all trading strategies. Are you trend trading or are you counter trend trading? Markets tend to spend most of the time range trading and less of the time trending. Trend traders typically have lower win-loss percentages. In other words, they don't necessarily win a lot of trades, but when they do win, they can catch some really big moves. They're going to get several false signals before catching the trend, but when they do, it could pay off pretty big. Counter trend traders are looking for smaller but more frequent wins. They're going to get fewer false signals, but the losses are potentially pretty decent if they're not protecting themselves. For example, a lot of counter trend traders will try to buy support and sell resistance as opposed to waiting for some sort of confirmation of a reversal. And if they happen to buy support right as the bottom falls out from underneath the market, they are exposed. So again, this is something that comes down to personality and preference. The way that my brain thinks is I like to look at things in a counter trend type of setup. So that's just that's what I've found to be most comfortable for me, and we'll leave it at that. So anyway, this is just kind of this is actually an intraday chart. I believe it's a 60-minute chart of that spans over 4 or 5 days in the S&P, and you'll notice that typically, even when the market is moving higher or lower, it'll do so in a bit of a range. So swing traders ideally would be looking to catch every rally up to the top of the range. They'd be looking to sell into it, and they'd be looking to buy the low end of the range. Whereas trend traders might get confirmation of a reversal and then buy in, and by the time they buy in, the market's coming the other way. So again, it's something you're going to have to determine what's best for you. But the idea here that I'm trying to point out is most days the markets are going to trade in ranges. However, there's going to be those, the handful of days out of 10 that we get what's called a trend day, and there is no range. The market just picks a direction and it goes that way all day. You'll notice with this arrow over here, anybody that was trying to sell into resistance here probably got their head handed to them, and so on and so forth. Okay, we already kind of discussed this, but I'll go over it again. And again, keep in mind, I'm a broker, so I have a different perspective than maybe you or a retail trader or someone else in the industry does, but this is just the way that I see it. And again, just keep in mind that I make a living on commission, so I'm a little biased. But with that said, I do believe commission matters. It's baggage. But I also believe that most people don't really think of it in the way maybe they should. For example, 1 point in the E-mini S&P is $50. 1 tick in bonds is $31.25. 1 tick in crude oil is $10. So a lot of traders, what they do is they go and find the cheapest commission they can find. However, you get what you pay for. If you can't get someone on the phone, if your platform crashes and you can't get someone to place your trade, that can be very, very, very expensive. So I would just like to point out, do you really think paying $1 or $2 difference in commission is going to decide success or failure when you're talking about each point in the S&P being $50? I would argue that it probably is not. And here's a couple of reasons why. Many traders that focus on getting the lowest commission, they feel like because they're paying such a low commission rate, they have the freedom to trade large quantities, and it really becomes a self-destruction type of scenario. They feel like they can trade 10, 20, 30 contracts really with no consequences, but that's not true. Even if their commission bill is low, the market tuition that they'll be paying could be very high. And I've always found that people that tend to have a better trading performance are those that trade less. So less is usually equal to more, believe it or not. And in a nutshell, what I'm trying to say is don't focus on rate, focus on your behavior, because your behavior determines how much you pay in commission far more than your rate does. If you want to save money, trade less. It's as simple as that. And I'm not saying trade less and give up opportunities. I'm saying if you're trading a lot, you're probably taking on too much risk, and you're probably not missing opportunities. You're doing the opposite. You're just churning and burning your own account. And unfortunately, that happens more often than it should. The goal is to make money, not to save it. If being with a reputable broker saves you one tick in fill prices, if we can save you one tick in the S&P by giving you market guidance, support resistance, by giving you quicker tech support, less aggressive forced liquidation, better customer service, freedom to trade all products. If we can save you one tick on a trade, you're way ahead. So let's go to common day trading pitfalls. I know we're kind of running short on time here, so real quick. One of the biggest pitfalls is being undercapitalized. Like I mentioned before, undercapitalization breeds fear, and that's exactly true. Undercapitalized accounts also might not have the means to hold overnight positions when necessary. You aren't doing your strategy any justice if you can't occasionally hold positions into the overnight session or even the following day. Technical patterns are not on timers. Another pitfall is overtrading. Day traders often have the propensity to always have a position on and to force trade entry based on boredom, not strategy. Being flat is not a missed opportunity. It's safety from unnecessary losses. Those that are flat to market are going to be better positioned to take advantage of promising opportunities. In my opinion, really good day trading opportunities might only come once or twice a week. It may not be get the real good ones. Tight stop orders is probably the biggest downfall that I see for newer traders. Stop orders are meant to protect traders from large losses, but multiple stop losses add up very quickly. I believe that stop orders might actually work toward trading failure in some cases rather than loss protection. Being stopped out before the market moves favorably creates emotional turmoil that bleeds into future trades. And on top of that, being stopped out over and over and over again, those small losses add up to big losses very quickly. If you're going to play, you got to play to win, not to lose. And this is a good example of a market that's trading in a range, but you'll notice anybody that placed traditional stop orders at any of these red arrows would have been stopped out before the market went in their direction. Now it's tough because most of the time, if you just absorb a little bit of pain, the market will come back and trade within the range. But there's always going to be that time where the market breaks out of the range and on a trend day and just keeps running. So that's where trading is tricky. There's nothing, I never said anything about this was easy. In some cases, it makes a lot of sense to use options to protect yourself instead of stop orders. Because at least with an option, you always have the ability to hold on to the trade and eventually it might come back. With an option, the trade isn't over when your option kicks in and your protection kicks in. Like a stop order pulls you out of the market and you're done. An option gives you a little bit of standing power. It doesn't mean you're never going to lose if you protect yourself with options, but it gives you a little more lasting power. That's for a whole different class. Okay, position sizing. We recommend initiating a position with one contract per $10,000. Some traders do 5 to 10 times this amount or even more per 10,000, but this is just my recommendation. You don't have to listen to me. Brokerage firms, in my opinion, are partly to blame for people overextending themselves. They advertise low margins and people tend to use what they can. If they're given leverage, they'll use it, unfortunately. But just because you can doesn't necessarily mean that you should. I believe you should trade less contracts and longer time frames. And let me tell you why. It might sound boring to trade fewer contracts using a 30-minute or a 60-minute chart and maybe only getting 1 or 2, maybe 3 trades a week. I know it sounds boring, but here's the reality. $50 per day equals, per trading day, equals $1,000 per month, equals $12,000 per year. Assuming you're skilled enough to net $50 per trading day, doesn't sound like much, does it? And you started with a $10,000 account, you would more than double your money in a year. It doesn't take 10 lots to make $50 a day. Instead, trading 10 lots likely decreases your odds of actually making $50 per day. By the time you pay commissions and you have the market risk, you're probably going to be behind the 8 ball. So if you trade 1 lot, you only have to make 1 point in the S&P. All right, price averaging, I believe, can actually be a good thing. Conventional wisdom says don't add to your losers, but well-capitalized accounts might benefit greatly from doing just that. Adding contracts in adverse moves lowers the trader's break-even point. You can scale in and you can scale out of trade. However, this is very dangerous territory. You want to tread lightly and don't overdo it. And if you are going to scale in, you had better be really, really conservative on your entries. Nibble on the way down. Don't overload yourself to a point where you have absolutely no wherewithal to ride out the volatility. So in conclusion, I believe successful day trading requires discipline, which means less frequent and logical trades, proper funding. You want to be able to hold positions overnight if necessary, and you have to have respect for the market. Thank you for attending. I appreciate it, but don't go anywhere yet. We've got plenty more for you. If you liked anything that we talked about today, or you have any questions about anything, you might find the answers in my books. I've written 3 books: Commodity Options, A Trader's First Book on Commodities, and Currency Trading in the Futures and Forex Markets. They're all available at any major book outlet, but Amazon is typically the cheapest. So I'm going to go ahead and pass the mic over to Gary here. Give me just a second here. If you have any questions, here's all of my contact information. You can shoot me an email or give me a call. And I appreciate everybody coming out. I hope to hear from you soon.
Thank you, Carly, for that excellent presentation and for your vital trading advice. I hope everyone was listening. Now, moving into my webinar. What we're looking at today is what I truly believe is what lies beneath all trends. And I've been studying this for now over 20 years. Before we begin, what is a market trend? A market trend, by definition in a dictionary, is a tendency of a financial or commodity market to move in a particular direction over time. Now, market trends do come in many shapes and sizes. What we're looking at now is a 5-minute chart. This is a 5-minute chart of crude oil from January 9th. A 5-minute chart showing a trend down, starting at around 9:30, ending around 10:15, and a move up, a trend up starting around 10:30, stopping after 11, between 11 and 12 Central Time. We're looking at lunchtime on the East Coast, and then a trend up. 2 intraday trends. On a daily chart of crude oil, we see a trend starting back below 90 here. As price action books below 90, what happens? The market continues to drop. We have a few stop-offs at 80 and 75. But look at the long-term trend we're looking at on a daily chart. Now, one of my favorite charts to trade off of course, when you're trend trading, is a weekly chart. Here's a weekly chart showing you the very strong downtrend in crude oil, starting at the end of June at around 107 and breaking down now below 45. And how do you catch trends like this? That's exactly what I'm going to show you. And you can even catch small trends like this. And remember, this is a weekly chart. This is almost 2 months of a move down. This a bit longer. But wow, this is one of my favorite moves in crude oil. Down, my favorite move in crude oil of all time was on a monthly chart. And here we see trends on a monthly chart. June 2008, 147.27, a high. Or actually July 2008. December 2008, the low, $35.17. Catching one like this would make your year quite profitable. But then we see a nice trend up and up, and then a trend down. Remember, this is a monthly chart, all the way out to this nice move down we saw starting in June 2014. And if anyone can explain to me how this drop took place, I'd like to hear it. Remember in 2007, All those articles written about peak oil. We're running out of crude oil. Really? So what moves markets? Technical analysis? Well, technical analysis helps timing entry and exits, but it does not move the markets. Fundamental analysis, looking at supply and demand. It happens to be a cause of market movement, but it's not what actually moves the markets. What actually moves the markets is buyers and sellers. It used to be those guys on the floors. Today, it's a few other people. And how do we measure buyers and sellers? Well, we look at volume and open interest. Volume, total amount of contracts, long or short. Key word there, or, long or short, traded for that day. Open interest, total number of contracts, long and short, that are entered for that day. And that's what we're looking at today, open interest. Open interest to go up, 1. We need a new long and a new short. And today, large commercial and financial institutions make up 70 to 80% of open interest. On June 6th, in the E-mini S&P, total open interest, 2.749 million contracts. Firms required to report their positions made up 2.214 million contracts. That's around 80%. Now, wouldn't it be nice if we could watch these massive institutions move through the markets? We can. And it comes from the CFTC, and it's called the Commitments of Traders Reports. First, a little history. In 1962, COT data began. Actually, June 30th, 1962. Back then, it was published once per month for 13 ag commodities. The CO2 report then became mid-month and month-end in 1990, and then moved to every 2 weeks in 1992 and to weekly in 2000. I wouldn't mind seeing this every day. The COT report is released more quickly. It used to be released at 6 days after the as of date, which is on Tuesdays. And now it's the third business day on Fridays. I've been arguing for a Wednesday release. We then saw 2 major new reports come out. September 2009, the CFT releases a completely different report for commodity futures called the Disaggregated COT Report. 2010, July, another completely different report for financial futures came out. Traders in Financial Futures. Now in the old legacy report, the old report, we saw commercials. Commercials were engaged in the business activities of the physical commodity. Because of this, commercials were not held to position limits. Non-commercials, or large speculators, were institutions involved in speculation of futures, and they were large enough that they were required to report positions to the CFTC, and they were held to position limits. And then we have non-reportables. That was left over after subtracting the commercial and non-commercial numbers from open interest. I think I fit in that category. Now in September 2008, a decision was made to remove swap dealers from the commercial category and create a new swap dealer classification to provide increased transparency. And this is important. The new categories: producers, merchants, processors, and users. And who are these people? Those are the original commercials. These are the people that are involved in the commodity, whether they're producing the commodity, processing, packing, or handling of this physical commodity. We've got swap dealers. This is an entity that deals primarily in swaps for a commodity and uses the futures markets to manage or hedge the risk associated with those swaps transactions. Money managers are the CTAs. These are people that are traders that are engaged in managing and conducting organized futures trading on behalf of other clients. And other reportables are big enough that they're required to report their positions, but they don't fit into the other categories. The next new report, Traders of Financial Futures. This report took a bit longer to develop and divides the financial futures market participants into the sell side and buy side. The categories for the Traders of Financial Futures report are dealer intermediary, asset managers, leverage funds, and other reportables. And a key item here, dealer intermediaries, as defined by the CFTC, and listen, they're the sell side of the market. What does that mean? And this is important. They're selling as a market's going up. Remember, in futures, you got buyers and sellers. For a market to be going up, you need both, buyers and sellers. Now, there is a correlation to the legacy report with the disaggregated report. Producers plus swap dealers equal commercials. Managed money plus other reportables equals non-commercials. So they literally took out the swap dealers from the commercial category. In traders of financial futures, there is no correlation. Now, why is this important? How important is this? Well, let's have a look. What we're looking at is the amounts outstanding of over-the-counter derivatives. And this comes from the Bank of International Settlements. You can check this out at BIS.org. And they track this. Total contracts of notional amounts outstanding in derivatives. This number here is 691.492 trillion. That's trillion with a T. The largest interest rate contracts. The largest, of course, is interest rate contracts. It's $563 trillion. Foreign exchange, $74.7 trillion. Equities, S&P, Dow, $6.9 trillion. Commodity contracts, $2.2 trillion. And look at gold. Many people ask, what's going on with gold? Well, right now I think gold's rising, and I'll show you why. But look at this. Notional amounts outstanding a couple years ago was $523 billion. Today, $319. That's a nice drop. A drop of over $200 billion. Now, in the U.S., 4 banks dominate in derivatives. And in the U.S., we're looking at around $239 trillion of notional value. And like I said, only 4 banks dominate this area. Who are those 4 banks? The dominant 4. J.P. Morgan Chase, Citi, Goldman Sachs, and Bank of America. And I'm sure you figured that out. And coming from the comptroller of the currency here in the U.S., a quick look at notional amounts of derivative contracts. Here's your top 4. Citi, J.P. Morgan, Goldman, Bank of America. Look at the numbers. $70 trillion in Citibank. And number 5 is Wells Fargo. Only $5 trillion. Big difference of the top 4. So that's why it's important to look at how money is moving through these markets. Big money. So how do you analyze and make money using the COT? The COT data is best analyzed when graphed as a net position in a weekly price chart. Knowing a simple net position is meaningless, as it must be compared with recent historical levels in a respective market. The relative bullishness or bearishness of the commercial net position, and we're talking about the old legacy report, is easier to see when you view the current net position with the highest and lowest net position over a select period of time. That's why I created the commercial tracker. And I created the commercial tracker a number of years ago. And here's a picture of it. The commercial tracker shows you all the markets. And this looks at the commercial net positions from the old legacy report. Back when I created this, it was the only report. And you can see clearly here, this goes back 52 weeks. I have a 12-month high, a 12-month low, and the colors show when we're at a 12-month high or 12-month low. And it's important to see when commercials go from a net short position to a net long position. That's why these colors are blue. And the commercial tracker is available at Trends and Futures. So looking at some examples of weekly charts with the COT, and I do show both reports on the COT, the legacy report and the disaggregated report for commodities, and the legacy report and the traders of financial futures for financials. And what we're looking at is crude oil, the weekly chart of crude. And what's amazing here is looking at the green line at the bottom. This is swap dealers. And they crossed down below producers, which are normally the sell side of crude oil. Swap dealers became the major strong sell side of crude oil. They actually became the largest hedgers of crude. Even at the high, all the way back up here at 110, producers were actually net long crude oil, something I have never seen. Actually, we saw that take place back in here, becoming net long. Producers, who's picking up the sell side of the market? Like I said, swap dealers. And check it out. Every time you see movement by big money, you catch moves up or down. Liquidation. Prices come down. Increased buying and selling. Prices come up. But again, swap dealers, sell side of crude oil. And interesting here, producers are starting to become net short once again, crude oil. As a matter of fact, the last drop in crude, the most recent drop in crude, you could have caught. Here it is, June going into July. Swap dealers liquidating net shorts, producers liquidating net shorts. And right now, look at producers now adding to net shorts. And swap dealers liquidating net shorts. This will be interesting if producers cross down below swap dealers. And Managed Money did have a bull move last week. So if you keep an eye on this, you'll know when crude oil is ready to go up again. Or keep an eye on this, and you'll know if crude oil prices will continue to drop. And these charts are all available at Trends and Futures. Corn, weekly chart, real simple. Swap dealers are speculators. However, what you need to look at are Managed Money and producers here. Bullish move. Back when? July 2012. A drought took place. But I'll tell you this, drought or no drought, if this wasn't taking place back down here, corn prices would not have gone up. Remember, you need buyers and sellers. Increased buying and selling, where the sell side is selling and the buy side is buying, the market's going up. And then we see some slight weakness here. In the COT, and prices are getting weak in corn. And then, bullish posturing. Corn comes down. January 2014, time to go long corn? Maybe. Look at big money. We have producers adding to net shorts, and Managed Money adding to net longs. And look at this big opened mouth here. It's someone I work with calls this the jaws of death. Actually, I call this the jaws of life. This is how you catch trends in the markets. And then you see the trend stops or a change in posturing. Bullish posture, bearish posture. Price starts coming down all the way to the lows. And then move up in corn. This past few weeks, what are we seeing in corn? Bearish posturing. Prices coming down. You want corn prices at 5. We'll need to see increased buying and selling by big money. Now looking at gold. In this market, like crude oil, back in here, July 2013, once again, swap dealers cross over producers, crossing down, becoming the strong side of the sell side of gold, hedging in gold. And like any other market, increased buying and selling, gold goes up to hit new highs. Liquidation, gold comes down, and it comes down hard. In all these areas that we're looking at, you're catching moves. Remember, this is a weekly chart. And now, gold, bullish posturing. We've seen bullish posturing off 1150 here, and it's increasing. Increasing bullish posturing by big money. That's how gold's going to retest 1400. Coffee. I'm looking at coffee for one major reason. We had a major fundamental in coffee last year. Dry weather in Brazil. A drought in Brazil. And look what happened. Coffee shot up. But like I said in other charts, If increased buying and selling was not taking place, drought or no drought in coffee, this would not have taken place. Then we have some sideways activity by big money, or actually some liquidation here. Coffee prices get weaker. And then, in the past few weeks, actually the past few months, liquidation by big money. And look at the price of coffee. Now playing at 160. This past week, bearish movement in coffee. But we need to watch the weather in Brazil. You want to catch moves like this, check out the COT. If you trade futures or Forex in currencies, this is big. You want to catch the euro dropping. Look at the strong bearish posture that took place in the springtime. And look at the euro drop. You want to catch the euro in a bull move. We have bullish moves here. Euro comes up. A bull move here. Euro comes up. But right now, extreme bearish posturing in the euro. Extreme. So how do you trade, say, the euro US dollar? Even in Forex, you want to look at the COT. And my favorite view of the COT is in the Japanese yen. Why do I say that? Bullish posturing in the yen back here, April 2012. We then had Abe become the new prime minister. And what happened? Bearish posturing taking place by big money. And you see that. It's been around for quite some time. And the yen's just been dropping and dropping and dropping. We've had some moves up here with some slight bull moves. But look at this bear move right in here. Up in here. Another drop in the yen. So, successful trading is not easy, but it does not have to be complicated. A trading strategy that identifies trades with the highest probability of success for all market conditions is what you need. And it's what I teach at Trends and Futures. Also, proper trade management until exit, maximizing winners and minimizing losers. And that's all part of the trading strategy. At Trends and Futures, we do have you covered. Daily videos from yours truly, teaching you what I call my MTS trading strategy that targets the best trades in all market conditions. You don't need 10 different trading strategies because you need one trading strategy that covers all market conditions. At Trends and Futures, the CRB Trend Trader gives you buy and sell recommendations, and I will highlight the ones with the highest probability of success and will manage those trades using my practical recommendations and guidance. Exit strategy. At Trends and Futures, you'll receive all new positions recommended by the CRB Trend Trader. You'll also receive a trade alert video analyzing those recommendations. Emails are sent when these are available. Each day, you receive position updates with specific exit strategies on all of the markets. Again, emails are sent when these are available. You'll also have access to the Futures and Forex Strategizers, which I created. They have daily and weekly comments regarding my trading strategy and the COT. I'll let you know if I see the COT moving and becoming either bullish or bearish. Time to catch those trends. You'll receive one 1-hour live members-only Common Sense trading webinar, which you'll want to participate in. You'll have access to all my education videos and PDFs. And you'll also have access to 6.5 years of Trend Trader trade history. So, at this time, write down the URL for a free 14-day trial. The URL you can write down, http:// www.trendsandfutures.com. Write this whole thing down and get in. Take your 14-day trial. You've got nothing to lose and everything to gain. Basically, if I can help you make money, that's why you want to take Trends and Futures. If you want, you can email me at Gary@trendsandfutures.com. My telephone number, 312-506-8706. You can also follow me on Twitter. And here's the URL for that. So, at this time, I'm going to open up questions and answer session with Carly and myself. So feel free to type in questions, and I'll let Carly know the questions that are being asked, and we can go from there. Carly?
Yeah.
I have a question from Chinmoy, is it? He's questioning, what is the best time frame for day trading? He says he wants to trade 2 round trips in a day.
Okay. I mean, again, this trading is subjective. It really is a personal choice as opposed to there's not a right or wrong answer. But with that said, I prefer, like I mentioned in the presentation, I prefer longer time frame charts. So, I mean, if you really are trying to get off 2 trades a day, I'd say you want to go with maybe a 15-minute to 30-minute chart. I actually prefer to use the 60. It takes out a lot of the noise. But with the 60-minute chart, you're not going to get too many signals, probably not 2 trades a day. So if you're looking for 2 trades a day, I'd say look at either the 30-minute or the 15-minute and see if it fits what you're looking for.
Okay, let's see for Curly. Can you tell? This is from Deepak. Carly, can you tell us if you use FXCM for Forex? I can't believe. Okay.
Okay, I'm not a big fan of Forex, and so I actually wrote a book, Currency Trading in the Forex and Futures Markets, and most of that book was aimed at trying to get people to understand the additional risks there are to trading Forex versus futures, and I highly encourage people to trade currency futures as opposed to Forex. So with that said, no, we did not have any exposure in Forex.
I wonder why they asked that. No, it must be that Swiss franc thing. No. Okay, I got another question for Carly here. How closely do you align? This is from Richard. How closely do you align your rationale and logic for trading with the New York Stock Exchange performance? Do you trade in harmony or are you independent?
Well, I mean, I would say personally, like what we try to do with any of our trades, whether it's day trading or position trading, we do a lot of what Gary just mentioned as far as looking at the COT reports. We kind of tab all the blogs and newsletters to see what the overall market sentiment is. So I would say, I mean, obviously we're looking at what's going on at the New York Stock Exchange, but we're kind of honing in on maybe outside forces as opposed to, you know, or I don't know, stock-specific information. I don't know if that, hopefully that answers the question.
Yeah, he'll ask it. Basically, let's see what we got here. We've got a bunch of more questions coming in. Okay, Marco is asking what happens after the 14-day trial. Marco, you can renew your subscription. It comes to $49 a month. That's the cost of Trends and Futures. And Kevin's asking, which is a better report, the legacy or the disaggregated report? Kevin, for me, at this time, because I want to see what swap dealers are doing and what real commercials are doing, I like the disaggregated report. I do find it much more transparent to big money moving through the market. I do, however, post both just to give you an idea how the legacy report, like I said, they're correlated. So you can look at both, but I do like looking at the disaggregated report. Michael's asking Carly, what is the key to changing your behavior of letting losers run and cutting profits short?
Yeah, I wish there was an easy answer for that. Really, it comes down to, you know, practice makes perfect, and it's just something that hopefully you can learn with experience. I'd say if you're struggling with some sort of, and trust me, we've all done it. Shoot, I've done it. It happens. If you're struggling with that sort of thing, sometimes the best thing to do is to walk away, clear your mind, and maybe once you're in a better position to trade, you can probably think a little more clearly and maybe change some of the behaviors that got you into trouble before. So, I mean, the one thing to remember with this stuff is the markets they're not going anywhere. They're going to be here for a long time, and there's always going to be opportunities. So you don't have to be in the mindset of thinking you have to have some sort of trade on or you have to be involved, because you don't. You can take a vacation from the markets just like you can anything else, and sometimes that's the best thing to do.
Now I got a question from CC, and I'm going to have to ask Carly to help me with this one. He's asking what international brokerage trades all currencies in the Forex. So I guess he's looking for a brokerage house internationally. Do you know of ones that trade all currencies in Forex?
Well, it gets a little complicated. We don't do a lot of Forex business, but we do offer it. We primarily use Gain Capital, which is Forex.com. You'd have access to really just about anything that's tradable there. The one thing to keep in mind, though, I don't know where you're located, but the U.S. citizens face an entirely different set of rules and regulations for Forex trading than overseas clients do. So a lot of overseas clients really aren't interested in trading with U.S. Forex firms. In fact, a lot of Forex firms set up a U.S. branch and an overseas branch so that they can cater to the different styles of rules and regulations. It gets a little bit complicated. But our experience has been with Gain Capital or Forex.com, and again, I prefer people trade currency futures. I think there's just a lot more market integrity. There's a lot better safeguards for client funds. So I'll keep it at that.
Okay, now we have a question here from Roger on comments on techniques to use day trade entries, smaller initial risk, to work into trades to be managed on daily or weekly or monthly time frames. Not quite sure, Roger, what exactly you're asking for here. Are you talking about taking a day trade and holding it into a position trade? I guess. Well,
right. I did kind of mention. I think it's a good idea for a lot of people are stuck in the idea of day trading to make sure they're out by the close, and generally that's probably a good idea. I mean, that's what the overall strategy is if that's what you're trying to do. But sometimes it makes sense to turn your day trade into a swing trade, and I'm not saying hold it for a couple weeks. I'm saying maybe for another 10 hours, 12 hours, maybe 24 hours, because a lot of times the market will make a move during the day, and then it just kind of gets pinned for the last couple hours of the day, and for example, it might be overbought, and then going into the close, and then it doesn't see any selling pressure until the overnight session. So somebody that's strictly day trading might have gotten out of a loser at the close, or might have gotten out of maybe even a break-even trade at the close and missed out on the signal that they got during the day session, but didn't actually play out until the overnight session. So when I say holding, if you're going to day trade, you want to consider day trading as like a 24-hour thing, not necessarily being absolutely out by the futures close at 4 o'clock Chicago time. So.
Okay, we got a question from Greg. Gary, with your plan, are you using weekly charts? Thus, do you only give opportunities once a week, or are they daily? Greg, I don't use weekly charts to enter trades. I use daily charts to enter trades. I also don't just use the COT report. I have key indicators that I think works best with the COT, and I have key indicators that I use on daily charts that I think works best with trading daily charts. That's where my MTS strategy comes in, and you can learn about that at Trends and Futures. Again, you don't just use the COT to jump into a market. You got to time your trades using technical indicators. I do teach, Marco, you asked in your videos, do you teach how to read and use those reports? Marco, I cover the COT report on all of my position updates, and I do cover the COT report on all new trades. So we always look at how big money's posturing in a market before we enter a trade, and on the daily charts, when I'm looking at updates, I'll tell you what's happening with big money. Also, looking at a weekly chart. So I always show daily and weekly charts on all my videos. How do you integrate the COT? Michael's asking, how do you integrate COT data into making a trading entry decision? Well, basically what I'm looking at is I'm watching for potential movement, bullish or bearish posturing taking place. And then I use the daily chart to give me an idea of when I want to enter the trade over a certain number or key area of resistance or support, both on a daily and weekly chart. Those are actually really good areas to get into these markets once everything's kind of flowing in that direction, especially when big money's supporting your trade. I think this is going to be Carly. Ram's asking, what percentage of stop loss do you recommend?
Okay. Honestly, I feel like the wider the stop, the better. And I know most people cringe at hearing that, but trust me when I say stops are meant to be run for some odd reason. You know, it's not that a lot of people have this idea that people can see their stops and they're gunning for them, and that's not necessarily true. It's just markets tend, you know, markets are sadistic. They tend to kind of push the limits, and they go towards major support and resistance area, which is where most people place their stops. So if you're going to use stops, it's usually better to give the market a lot of room to breathe. I think maybe a better, if you're going to be a day trader that's you know, in and out of positions frequently over the course of, say, a week, you may want to consider not using stops, but maybe buying, you know, weekly calls and puts for protection, just in case something really gets out of hand. You at least have a hedge to limit your risk. Because, you know, like I said, stops are great because they limit your risk, but the problem is they tend to get hit, and so you end up you know, small losses can add up to very big losses pretty quickly, and it can be frustrating and painful.
Yes, it can. Lawrence has a question. Gary, is there generally a time delay for a speculator to get long or short when you see a change in net long or short in the commercials? Lawrence, there's really, it's not 1 week that you're looking at. If you see a change from net long to net short, you're not just jumping in the market net short. You got to give that some time. You also want to look at the daily chart to see what's happening. But usually when it takes place a week after week after week, you'll see a trend forming or developing, and that's when you could be catching some of these trends. Again, using a daily chart with a weekly chart, or vice versa, a weekly chart with a daily chart, you're looking to really focus on targeting your timing. And again, I use other technical indicators to do that. To me, the Commitment of Traders report is really not a technical indicator by far. It's actually more fundamental. It's telling you how big money is posturing in the market. And Richard, you have a question about what is available for tools, charts, and other statistics at your website that I can use to follow your logic for recommending a specific trade. We have charts at the site. You'll see something called the Futures Strategizer and the Forex Strategizer at the site. That's the most used tool at Trends and Futures, and you'll see why when you start using that. It's a very good tool to manage my momentous trading strategy, or MTS, and how you can catch trades, you know, on a daily chart and on a weekly chart. But more importantly, the Futures and Forex Strategizer focuses on a daily chart. Lawrence, are you asking? Okay, Lawrence is asking a question. What is the average length of your trades? Is that for? Because as far as the trending trades go, I mean, we could be in a trade like in crude oil. We've been short crude oil since July 11th, and you're basically rolling over your contracts. That's a long-term windfall profit trade. It's not, that doesn't happen every day, but when it does happen, you want to catch those. July 11th was the time that we shorted crude oil. And like I said, you have to know how to roll over those contracts because you really don't want to get out of a trade like that, especially when you see what's happening with big money. So that's how you take that. Let's see here. Oh, Greg again. Greg, see, I know that his question is, I know that a 2-week trial is a nice start, and I think you said after 2 weeks it turns into a $49 per month subscription. How long do you feel it takes for you to get a strong understanding on how your plan works? Well, Greg, first of all, there's an awful lot of educational videos at the site that you start watching immediately. Also, take advantage of the Common Sense Trading webinars that I give to members. You can ask me questions there about anything you find at Trends and Futures. Also, you can email me any questions you have. I want to get your learning curve down as quickly as possible so you can take advantage of the tools at Trends and Futures and see how they can help you make money. I guess we'll take a few more questions. If anyone else has any more questions, you can just ask them now. Okay. Let's see here. Andy. Andy's asking, at what time At what time on Fridays does the CFTC release this data? The CFTC releases this data every Friday at 3:30 p.m. Eastern Time. Also here, what's going on? Barry, why in some markets are swap dealers hedgers and in others speculators? That's a tough question. It's not really a tough question. It's actually a question that you can get really into, is because in gold, in silver, in platinum and palladium, swap dealers are actually hedgers. And I think the reason for that is because the ETFs in metals are required to hold the metal, the actual metal. Like GLD holds a warehouse full of gold. Well, how do they hedge that gold? Well, they can go to a swap dealer and they can hedge gold. I have to say, I think it has to do with, in other markets like USO, there's a crude oil ETF. And I think that crude oil ETF has a $1.6 or $1.3 billion in assets. Those assets are long-only futures contracts that roll over every month. And USO is not doing so well right now. So that I'm not sure if that 1.3 billion in assets is still there, but that might be another reason why we see swap dealers hedging crude oil. And in other markets, they're speculating. That's what they're being paid to do. Okay, I'm seeing a lot of thank yous coming in from everybody now, so we'll have to bring this to an end. I want to say that as we come to the end of today's webinar, I want to thank all of you for joining us today. I also want to thank Carly for joining me and sharing her expert insight on day trading. I hope that you learned here today. I hope what you learned here today helps make 2015 your most profitable trading year. So as I end all my videos at Trends and Futures, where I hope to see you all, the most important thing is for you to be well. Then you can trade well and follow the trends. See you on the next webinar.